Owning a football club sounds like buying 90 minutes of entertainment every weekend.
Customers can
But the
easily
real
switch,
business runs every
but
hour of the
fans
year.
are
On the
thousands of
surface, you
investors.
own players, a
But
manager, a
only
stadium, and a
is why
badge.
billionaires keep
Underneath, you
buying
own a media
clubs.
company, a global brand, talent trading
To answer
operation,
that,
a
start
property
with the
asset,
money
and one of
entering
the
the building. A major
strangest
club
customer
depends on
relationships in
three
business.
core revenue
The fan
engines.
is not just a customer, because the fan usually cannot switch brands when the product gets worse. That loyalty is the first clue to why billionaires keep buying clubs, even when profits look surprisingly thin. The second clue is scarcity, because there are thousands of wealthy investors, but only a small number of clubs with history, league access, trophies, produce, and global attention. So the real question is not simply whether a football club makes money. The better question is what exactly an owner is buying when the club itself may struggle to produce conventional profits. To answer that, start with the money entering the building. At the highest level, a major club usually depends on three core revenue engines: match day, broadcasting, and commercial income. Match day income is the easiest to understand because fans physically arrive and spend money in one place. Tickets, hospitality suites, food, parking, merchandise, and premium seating all turn attendance into revenue. A full stadium looks like the perfect business because thousands of people are paying at the same time. But the stadium also creates the first hard limit. A 70,000 seat stadium cannot sell 100,000 seats unless the club expands, raises prices, or adds more events. That means matchday revenue is valuable, but physically constrained by capacity. And the calendar broadcasting broke that constraint. Once leagues could sell the same match to millions of households, the audience became much larger than the stadium itself. A local club could suddenly earn money from viewers who lived hundreds or thousands of miles away. That transformed elite football from a gate-driven business into a media rights business. The economic importance of television is why league position matters even when the stadium is sold out every week. Better performance can change central distributions, prize payments, and access to competitions with much larger broadcast pools. Third engine is commercial revenue. And this is where global clubs become especially powerful. A shirt sponsor is not really paying for fabric on a jersey. The sponsor is paying for access to millions of eyeballs, social feeds, television broadcasts, and emotional associations. The same logic applies to kit suppliers, airlines, banks, technology companies, beverage brands, and regional partners. A football club can sell the same fan attention repeatedly to different commercial partners without selling another match ticket. That is why the largest clubs increasingly resemble global advertising platforms wrapped around a sports team. UEFA's latest finance landscape expects European top division club revenue to pass 30 billion euros for 2025. That sounds like proof that owning a club must be enormously profitable. It is not. UEFA also reports that top division clubs still recorded roughly 1 billion euros of aggregate pre-tax losses in 2024. Rumgord revenue and weak profit can exist at the same time. Because football has an unusual habit of spending new income almost as quickly as it earns it, the main destination is labor. Players are the product, talent, the inventory, and often the largest cost base at the same time. When a club earns another 50 million, competitors know it can afford better players and higher wages. That pushes the market upward. Successes creates revenue. Success also increases the price of staying successful. This is why football can feel like an arms race where every extra dollar of income creates pressure to spend another dollar. Wages are especially dangerous because they repeat every week regardless of results. A transfer fee may be negotiated once, but salary obligations continue through the contract. If the player performs brilliantly, the wage can look cheap. If the player fails, is injured, or loses form, the same contract becomes an expensive fixed burden. That is why the wage bill often tells you more about financial risk than the headline transfer fee. Transfers themselves are also more complicated than the headlines suggest. FIFA says international transfer spending in men's professional football reached a record $13.11 billion in 2025. That number shows how much capital moves through football before a single ticket is sold. But when a club buys a player for $80 million on a 5-year contract, accounting does not normally treat the entire fee as 1 year's expense. Instead, the transfer cost is generally amortized across the contract term. An $80 million fee over 5 years, therefore, creates roughly $66 million of annual amortization before wages and other costs. This accounting treatment can make an expensive signing look more manageable in the short term. It can also create future obligations that pile up when a club signs several expensive players at once. The squad may look new, but the old transfer costs remain inside the accounts for years. Selling players can reverse the effect. Player developed internally may have a very low book value, even if the market values him at $50 million. If the club sells that academy player, much of the fee can appear as accounting profit. That makes youth development more than a sporting philosophy. It's a financial engine. An academy can produce first-team players, reduce recruitment costs, create transfer profits, and strengthen the emotional connection between supporters and the club. Best academies therefore operate like venture portfolios, where a small number of breakout successes can pay for many players who never reach the top level. But none of this matters if results collapse badly enough. Football is one of the rare businesses where a few poor months can change the entire revenue model. In leagues with promotion and relegation, the downside can be dramatic. A club can build wages, debt, contracts around top division income, and then lose that income in a single season. Relegation does not reduce every cost at the same speed. Players still have contracts, stadiums still require maintenance, and debt still requires payment. Revenue can fall faster than expenses. That mismatch is what turns a bad season into a financial emergency. European competition creates the opposite effect. Qualifying for the Champions League or another major competition can add prize money, broadcast revenue, sponsorship value, matchday income, and global visibility. Missing qualification can remove those benefits almost immediately. So the difference between 4th place and 5th place may be worth far more than the points table suggests. Creates one of football's most important feedback loops. Winning generates money, money improves the stronger squad increases the chance of winning again, and repeated success attracts more commercial demand. But the same loop can run backward. Failure reduces income, lower income limits recruitment, weaker recruitment hurts results, and poor results reduce income again. That is why established giants can remain powerful for decades, while once successful clubs can fall surprisingly quickly. The stadium sits at the center of another economic contradiction. Supporters see it as the club's home. Owners see it as an asset that may sit underused for much of the week. A modern stadium can generate revenue from premium hospitality, concerts, conferences, museums, tours, restaurants, hotels, and naming agreements. The goal is to make the building earn money even when no football is being played. 2026 Football Money League highlighted how leading clubs increasingly use stadium assets and non-match day events to diversify revenue. That makes real estate strategy part of football strategy. A club with an old, small stadium may have huge support, but still struggle to monetize that support at the same level as a rival with modern premium facilities. Building or renovating a stadium can therefore unlock future revenue. It can also require enormous capital, years of planning, significant financing costs. UEFA reports that financing expenses across European clubs have increased by more than 50% since the pandemic. That matters because debt changes who gets paid first. Fans may think revenue belongs to transfers and trophies, but lenders expect interest and principal, regardless of the league table. A club can be famous, valuable, and cash generative while still feeling financially constrained because debt absorbs flexibility. This is where ownership structure becomes crucial. One owner may inject equity and accept low returns for years. Another may borrow aggressively. Another may demand dividends. Another may use the club as part of a broader sports, media, tourism, or national branding strategy. Different motives can produce completely different financial behavior, even at clubs with similar revenue. Some owners primarily want appreciation in the value of the asset. That strategy can work even if annual profit is modest. A club bought for $500 million is later worth $3 billion. The owner's return may come mostly from capital appreciation rather than yearly cash distributions. That makes football resemble high-end real estate or art in one important respect. Scarce trophy assets can rise dramatically in value even when their current income yield looks unimpressive. The biggest clubs also benefit from brand durability. A bad restaurant can lose customers permanently. A football club can lose 10 matches and still sell out the next home game. That emotional lock-in is extraordinarily rare in normal consumer markets. It is also why owners must be careful. Supporters may be loyal to the club, but they are not necessarily loyal to the owner. Fans can protest ticket prices, ownership decisions, sponsorship deals, stadium moves, competition formats, and perceived attacks on tradition. A privately owned club can therefore behave like a public cultural institution. Legally, shareholders may own the company. Emotionally, millions of supporters feel that they own part of its identity. Tension is one reason football ownership creates political and reputational risk that ordinary businesses rarely face. Manchester United offers one of the clearest examples of how financial structure can reshape the ownership story. In 2005, The Glazer family's leveraged takeover placed substantial acquisition debt onto the club. The club remained one of the world's most commercially powerful football brands. But the presence of debt, interest costs, and owner-related financial flows became a long-running source of supporter anger. The important point is not that debt automatically destroys a football club. The important point is that two people can look at the same balance sheets and see completely different things. An investor may see efficient leverage on a valuable asset. A supporter fist may see money leaving the club instead of buying players or improving facilities. Both views can be economically coherent because they start with different definitions of success. That is the central contradiction of football ownership. The owner can maximize enterprise value, while supporters judge success almost entirely through trophies, identity, and the quality of the team. A club can therefore become more valuable while becoming less satisfying to the people who care about it most. The opposite can happen too. An owner can spend aggressively to chase trophies and make supporters happy, while weakening the long-term balance sheet. Football constantly forces owners to trade financial discipline against competitive ambition. Regulators try to limit the most dangerous version of that trade-off. UFA and domestic leagues use financial sustainability rules designed to restrict chronic overspending and link squad costs more closely to revenue. These rules do not end competition for players. Change the competition into a battle over accounting, commercial growth, contract structures, player sales, and permissible investment. Smart financial management becomes a competitive advantage. So does data. A club that identifies undervalued players before richer rivals can turn scouting into economic alpha. Recruit a player for $10 million, improve him, receive strong performances, and sell him for $50 million, and the club wins twice. It wins on the field while the player is there and wins financially when he leaves. This model has helped smaller clubs compete above their natural revenue level for periods of time. But efficiency has limits. A rich club can afford several mistakes that would destroy a smaller club's season or balance sheet. That ability to survive errors is itself a competitive advantage. Money does not guarantee smart decisions, but it buys more attempts. It is one reason the gap between elite clubs and ordinary clubs can become self-reinforcing. The biggest teams receive more international attention. More attention attracts bigger sponsors support larger wage bills. Larger wage bills attract stronger players. Stronger players help keep the club in the competitions that generate the most attention. The loop keeps turning. Social media has made that loop global. A supporter in Karachi, Lagos, Jakarta, or New York may never enter the stadium but still contributes economic value. They watch highlights, follow club accounts, buy shirts, use sponsored products, play football games, and increase the audience sold to commercial partners. Changes what a football club actually is. The local stadium remains emotionally central, but the economic audience can be worldwide. A giant club is therefore monetizing two markets at once. It serves local match-going supporters and a global digital fan base. Two groups do not always want the same thing. Local fans may care about ticket prices, kickoff times, and neighborhood identity. Global fans may care more about star players, streaming access, trophies, and social content. Owners must grow the global product without convincing local supporters that the club has forgotten its roots. That balance is difficult because authenticity itself is part of the commercial value. The more corporate the club becomes, the more valuable its traditional image may become. This is why old crests, historic stadiums, famous rivalries, and club mythology can be monetized without being easy to replace. History is an intangible asset, and unlike a factory, nobody can build 100 years of history next year. That scarcity helps explain rising club valuations. Deloitte's 2026 Money League reported Real Madrid at about 1.16 billion euros of revenue for the 2024-25 season, with several other elite clubs approaching or exceeding the high hundreds of millions. At that scale, football clubs compete with major entertainment businesses for global attention, yet high revenue still does not guarantee high profit. UEFA says non-wage operating costs now absorb about 36% of club revenue, the highest share in 15 years. Stadium operations, staff, security, travel, technology, marketing, retail, academies, administration, financing all consume money before the owner sees a return. This is why the cleanest revenue chart can hide a messy business underneath. The club may announce record income and still need new capital. It may sell a player to balance the books. It may delay infrastructure. It may refinance debt. It may raise ticket prices. Every decision changes the relationship between sporting performance, fan satisfaction, and financial stability. Investors still keep coming. UEFA identified 123 investment transactions across European men's and women's clubs in 2025, an all-time high. That tells you the attraction is bigger than one season's profit margin. Investors are buying scarcity, media exposure, cultural relevance, real estate potential, player development systems, and the possibility of future appreciation. They are also increasingly buying networks instead of individual clubs. Multi-club ownership groups connect teams in different countries under one capital structure. One club may develop young players. Another may provide a pathway into a stronger league. A flagship club captures the largest audience and commercial value. Shared scouting, data, recruitment, sponsorship, and executive expertise can reduce duplication across the network. In theory, the network becomes more valuable than the clubs would be separately. In practice, this model creates new questions about competitive integrity, supporter identity, whether smaller clubs become feeders for the flagship. That tension will shape the next era of football ownership. Private equity, sovereign wealth, family offices, American sports investors, technology billionaires are all attracted to the same limited pool of recognizable clubs. The 2026 World Cup has only increased the global commercial spotlight around the sport. But the most important economic lesson is not that football is automatically a wonderful investment. Many clubs lose money. Many owners inject capital repeatedly. Many transfers fail. Many stadium projects overrun budgets. Sporting results remain painfully unpredictable. The attraction survives because the upside is not measured only in annual profit. Owning a football club can create status, access, political visibility, commercial connections, global influence, a scarce asset that may appreciate for decades. For a conventional investor, some of those benefits are difficult to put into a spreadsheet. For a billionaire buyer, they may be the entire point. The club therefore has two scoreboards. One scoreboard counts goals, points, trophies, and league position. The other counts revenue, wages, debt, transfer profits, commercial growth, and enterprise value. The most successful owners understand that the two scoreboards are connected, but never perfectly aligned. Overspend for trophies, and the finances can break. Protect the balance sheet too aggressively, and the team can become uncompetitive. Almer's supporters, and the brand itself can be damaged. Almer's the global audience, and growth can stall. Football ownership is the art of balancing all four pressures at once. That is why 90 minutes can be misleading. The match is the visible product, but it is only the final output of a much larger economic machine. Behind every kickoff sits a network of contracts, media rights, debt, sponsorships, player valuations, academy investments, property decisions, and millions of emotionally committed customers. The billionaire in the director's box is not simply watching a game. Watching the weekly public performance of an asset whose value depends on both irrational passion and disciplined economics. And that is the final paradox. Football is valuable precisely because supporters do not treat it like a normal business. The moment the owner forgets that, the business can lose the very thing that made it valuable in the first place. So the economics of owning a football club are not really about buying 90 minutes of football. They are about owning a scarce piece of culture and trying to turn loyalty, attention, talent, and history into sustainable economic value without destroying the emotion that created the value.